Hello, everybody. My name is Eugene Yashin. I'm a Chief Investment Officer and Portfolio Manager at Signet Financial Management. And today I would like to update you on the happenings in the stock market as of June 2020. Please take a look at the disclaimers and disclosures. So today we'll talk about US equities. I will update you on the size and style dynamics. We will take a look at some macro statistics we pay attention to, like yield curve and short-term interest rate spreads. We will take a look at valuation spreads. Then we will dive into our multi-factor framework, and we will take a look at which factors work and which don't. Then I will briefly discuss the recent rebalancing we've done to some of our actively managed strategies. And we will touch upon our newer strategy, small cap strategy. So the market is predominantly dominated by coronavirus right now. Again, for the long run, we still believe the environment is supportive for US equities. And we understand that we need to be very selective and buy companies with strong fundamentals, the companies which have all the probability of survivorship through recession. And we use the barbell approach where we buy on one side, we have a very good composition of value firms, and on the other side, we are offsetting value bet with growth, but we still have growth at a reasonable price tilt in the portfolio. We are in self-imposed recession, and the market as a forward-looking indicator went down in March, and really with the same velocity bounced back in April. The virus and the fear of virus can change things in the short run, but I think in the long run, we have American businesses flexible, agile, and with all new technological advancements we've experienced over the last decade, the society functions and businesses still function as ongoing concerns, most of businesses. So let's take a look at the value growth dynamics. We're in a very deep and very long, pretty much a decade of large growth domination. And you can see that on the graph as well, that there's been a pretty long phase of growth. Looking at the valuation spreads, this graph shows the difference between most expensive companies and the cheapest companies. And you can see that the difference reached in March 3 standard deviation above the normal conditions over the long run. So we are going through very extreme times. There is clear opportunity of establishing a value tilt in the portfolio and just capitalizing on things going back to normal, even albeit slowly but surely. So we saw in April the valuation spread going down to 2.5 standard deviations, but still very much elevated from the historic norms. As I mentioned on the size, large cap has been very dominant. The market perceives larger firms, especially IT giants, as and for a lot of reasons, as much more immune to current recession, and we can see that in the market behavior. At the same time, we recognize that the extreme levels and the law of infatuation with large cap growers can actually recede going forward when things go normal and back to normal firms become much more attractive from the valuation standpoint. And smaller firms, not necessarily micro caps, but the companies of $1, $2, $3 billion market cap could become much more attractive because of their valuation. On the yield curve slope, we can see the orange line, more traditional 10-year versus 3 months. We can see the slope perking up, which is a normal behavior of the yield curve when the economy is expected to get out of recession at some point in the future. So the market predicts, going forward, the growth becoming a little stronger from the depressed levels. When we conduct our multi-factor macroeconomic forecast, we combine the macro indicators with micro indicators. And by doing so, we actually see that communication services, consumer staples, industrials, information technology, and materials are looking a little more promising. Communication services, very easy to explain with all the streaming and Internet of Things going on and being so much more important during the pandemic times. Consumer staples is a defensive mechanism. Industrials probably still counting on some infrastructure initiatives across the country in the future. Yeah, obviously information technology kind of resonating with communication services. Consumer discretionary is neutral. Consumer discretionary made a huge U-turn from looking negative just a month ago to becoming a little more promising, a little more positive with all the stimulus packages and PPP loans and unemployment benefits. On the negative side, we have energy, financials, real estate, healthcare, and utilities. We believe healthcare might be more treated toward neutral because there's probably going to be less political pressure exerted on the sector due to coronavirus. So on the more attractive side, information technology and industrials. On the less attractive, energy and financials. And this is a dynamic of how things are looking when we marry macro and bottom-up indicators across the board. The industrials, information technology, communication services looking pretty healthy. Consumer staples gaining some momentum, but the rest of the sectors looks, financials kind of getting depressed because of low interest rates and the expectation of low interest rates staying low. Again, I just reiterate with the more of the necessity from the healthcare sector, biotech and pharmaceuticals producing vaccine and other things against the coronavirus. We don't think healthcare is going to be as politically pressured this time around in the election season. And this is more of a macro view. And what's interesting is from the macro view, consumer discretionary and consumer staples are looking a little weaker. But if you look at the bottom-up view, consumer staples, especially and consumer discretionary, actually looking a little more appealing. So that's a very interesting. So when we marry the macro view with the bottom-up view, at least consumer discretionary becomes neutral and consumer staples become an overweight. So just to reiterate, we favor barbell approach where we have some value stocks in the portfolio, some growth stocks, and we have growth at reasonable price tilt in the portfolio. Virus still presents and poses a lot of unknowns, a lot of unanswered questions yet. So in the short run, it might make markets a little more volatile. But clearly, the markets do price in the economic recovery starting in the second half of this year. So when we look at the market on aggregate, we follow multiple factor groups, and you can see that this heat map represents the performance of each factor group in 2019 and the beginning of 2020. And you can see that value has been in the doghouse for the major part of 2020 and only perking up in April when those valuation spreads started receding from historic highs. Growth has been pretty good, and safety obviously hit one of the major themes, became one of the major themes in March when the markets went down. Let's talk a little bit about our strategical equity portfolio rebalancing. This polar chart depicts how well or not so well we are positioned with regards to exposure to different factors we believe work in the long run. It's been interesting last couple of years when the factor groups didn't really offset the underperformance of value. If prior to 2018 we had other, yield, profitability, momentum offsetting the underperformance of value for the most part of 2010-2020 decade. The last couple of years, investors became pretty emotional, extrapolating what they've experienced at the beginning of the decade into the future, and the departure from reasonable pricing became more extreme, as we saw, which culminated in March valuation spreads. So in our all equity portfolio, we had communication services contributing to performance, energy, healthcare, industrials, materials, and utilities. But we had some weaker showing in consumer discretionary, consumer staples, financials, because of the interest rates and the worries on consumer credit, information technology, and real estate. Again, we keep the mid-cap tilt in our strategical equity portfolio. We have no small cap for the most part in the portfolio because and we'll talk about it later on, we have created a small cap strategy, which we believe gives our clients a much better exposure to small cap. We're tilting slightly towards value because we see a huge opportunity when things go back to normal and increase our GARP tilt, but still we're keeping pretty much barbell shape where we have a very well diversified portfolio from the style standpoint with good growers and good value firms. Our sectors, we overweight industrials, information technology with the emphasis on software, and we again closed gaps at our last rebalancing in consumer staples and healthcare. And this is the composition of strategical equity portfolio. You can see that is very well diversified. We do have large cap growth, but a pretty good representation of large cap and mid cap value as well. The changes in strategic dividend equity portfolio, we maintain the large cap posture. We inherently have value tilt because we have firms which pay dividends in the portfolio. At the last rebalancing, we trimmed consumer discretionary and we bumped information technology and industrials. Again, a very well diversified portfolio. We understand the leadership of large cap IT firms is perceived uncontested, but we, knowing the history of what panned out after the dot-com era, after, with Nifty 50 firms after 1964, 1968 era of 4 years of domination of large cap growth firms, we remember that there's this period is followed by an extended period of value leadership. So we have a very good, even strategic dividend portfolio representation of information technology, but we believe that other more value-oriented sectors will have their say in the future. Again, this portfolio is much more value-oriented. And now I would like to very quickly again reiterate our small cap strategy. We have right now about 200 stocks in the portfolio. Fundamentally strong companies, a lot of companies in Russell 2000, which is the benchmark for small caps, do not make money, lose money, unprofitable. Well, we avoid that by actually having our multi-factor framework applied here. We rebalance semi-annually and not on the index schedule. So that way we avoid actually, the companies just recently added to the index being run up and those which were dumped from the index getting depressed. We have more than 3 years of live results, very well diversified with all sectors represented. And right now we have pretty much a neutral value growth posturing with little tilt towards value in the portfolio. So the strategy takes advantage of small cap index inefficiencies, like I was mentioning, a lot of companies not really making money, and allows for easy tax loss harvesting when we rebalance the portfolio. And this is just the composition of the portfolio, and you can see that. Again, it's a very well diversified portfolio with great representation of healthcare, financials, industrials, information technology. And mostly small cap, but we have a little bit of a mid cap and one firm probably becoming a large cap value. That concludes my presentation. If you have any questions, please do not hesitate to reach out to your advisors or to me, and we will have them answered. Have a great day.